Ever lost sleep worrying about your money? I mean, really worrying. It sounds crazy. But back in the 1930s, during the Great Depression, people saw their life savings vanish overnight because banks were collapsing left and right. That's what makes the work of our deep dive subjects today so important. They actually figured out why this happens and how to prevent it.
What's fascinating is that the 2022 Nobel Prize in Economics wasn't for some abstract theory. It was for understanding the nuts and bolts of banking and the very human behavior that can make it go haywire.
Okay, so we're talking about Ben Bernanke, Douglas Diamond, and Philip Dybvig. Now, I'll admit, banking doesn't exactly scream thriller movie.
But when you realize these guys cracked the code on financial crises, things get a lot more interesting.
Exactly. And it all starts with a simple question. Why do banks even exist? I mean, beyond just stashing our cash.
That's where Diamond and Dybvig's work comes in. They created a model showing how banks bridge the gap between savers, like you and me, who might need to access our money quickly, and borrowers who need loans for, say, a house or a business, which take years to repay.
Okay, that makes sense. But how does that actually work in practice?
Imagine you deposit $100 into your account. You might take out $20 for groceries later, but the bank knows it doesn't need the full $100 sitting around. So they lend out a chunk of it, say $80, to someone else who needs it.
So my money is helping someone buy a house, potentially.
Exactly. It's called maturity transformation, this idea of turning short-term deposits into long-term loans. To help you visualize it, think of pipes. Your deposit is a short pipe, a mortgage is a loon one, and the bank connects them.
Okay, that's a pretty cool analogy. But I've heard banks actually create money too. How does that fit in?
That's the beauty of this system. By lending out a portion of deposits, banks effectively increase the money supply. Let's say the borrower takes that $80 loan and buys a car. The car seller now deposits that money back into the bank, who can then lend out a portion of that too. This cycle continues, with the initial deposit leading to multiple loans.
So it's not like they have a magic money printing machine in the back.
Not quite. It's more like a money multiplier effect, where each deposit ripples through the system, creating new economic activity along the way.
Wow, that's incredible. But if it's so great, what's the catch?
Well, this whole system relies on a delicate balance of trust. Banks need to accurately assess risk to make sure loans are repaid, and depositors need to trust that their money is safe and accessible when they need it. When that trust erodes, well, that's when things can go wrong.
You're talking about bank runs, right? I've seen those in movies. Everyone panicking, demanding their money back all at once.
Exactly. And it's not just a Hollywood invention. One of the earliest recorded bank runs happened in 1660 in, you guessed it, Stockholm.
Wait, seriously, tell me more about this.
Picture this. 17th century Stockholm. People are lugging around these massive copper coins for everyday transactions. It's cumbersome, inconvenient, and a logistical nightmare.
Talk about a workout just to buy groceries. So what happened?
The government decided to introduce new copper plates, much lighter, but with the same value. Sounds great in theory, right? But people quickly realized the old heavy coins they had deposited in the bank were now worth more in pure copper weight.
Oh no, I see where this is going.
You got it. Everyone rushed to the bank to withdraw their old coins before the value of copper dropped, sparking one of the first bank runs in history.
Wow. So even back then, this fear of losing out was enough to trigger a financial meltdown.
And it highlights the inherent vulnerability of this system. Remember maturity transformation. Banks lend out money long-term, but a sudden surge in withdrawals means they might not have the cash on hand to meet those demands.
Oh, okay, now I'm starting to understand why people get so nervous about the security of their banks. It's like this ghost of financial history always looming in the background.
Exactly. And those ghosts can have very real consequences, as we saw during the Great Depression, which is where Ben Bernanke's research really comes into play.
So how does Bernanke's work connect to all of this? What did he discover about the Great Depression?
Bernanke's insights were groundbreaking. He didn't just study the Great Depression. He unearthed a fundamental truth about banking's role in it.
All right, I'm hooked. Tell me everything. So how does Bernanke's work connect to all of this? What did he discover about the Great Depression?
Bernanke dove headfirst into the economic carnage of the 1930s and discovered that bank failures weren't just a side effect of the Depression. They were a major driving force.
So it's like saying the earthquake wasn't just bad luck. It also caused the tsunami that wiped out the whole coastline.
Exactly. When banks collapse on a large scale, it creates this devastating ripple effect. Remember how we talked about banks connecting those short-term and long-term financial pipes? When those pipes break, The entire flow of money through the economy gets disrupted.
Okay, so people lose their savings. That's obviously terrible. But what's the long-term damage? What makes it so hard to recover?
Imagine a town where every single business, big or small, suddenly loses its ability to get loans. No one can invest, no one can expand, and new businesses can't get off the ground. It brings everything to a grinding halt.
And it's not just about money, right? There's this psychological impact too.
Absolutely. When people lose faith in the banking system, they start hoarding cash, which further constricts the money supply. It becomes a self-fulfilling prophecy of economic doom. Bernanke's research showed just how deep and long-lasting this damage could be.
So this is why governments went into overdrive during the 2008 financial crisis and even during the pandemic. They were trying to prevent another Great Depression.
Exactly. Bernanke's work gave policymakers a roadmap for preventing financial meltdowns. By providing emergency loans and guarantees, they aim to restore confidence in the system and prevent those devastating bank runs.
Which brings us to Diamond's other major contribution. We've talked about banks assessing risk for loans, but who's assessing the risk of the banks themselves?
It's a crucial question. Banks are businesses too, and like any business, they can make mistakes, take on too much risk, or even engage in reckless behavior. That's where regulation comes in.
So we need a system to keep an eye on the banks to make sure they're not getting themselves into trouble.
Precisely. Think of it like a referee in a sports game. They're there to enforce the rules and ensure fair play, even if it means penalizing a team for breaking the rules.
So what are some of the ways we monitor banks and try to prevent these crises?
One of the most important is deposit insurance. This is a safety net for depositors, guaranteeing that even if a bank fails, they'll get their money back up to a certain amount.
That's reassuring to know. So deposit insurance is like having a backup parachute, just in case.
Exactly. It helps to prevent those panic-driven bank runs. But like any safety net, it has its own set of challenges.
Like what? What are some of the downsides of deposit insurance?
Well, one potential issue is something called moral hazard. If banks know they're protected by deposit insurance, they might be more likely to take on excessive risks. They know that even if those risks backfire, the government will bail them out.
So it's a delicate balancing act. We need to protect depositors and prevent bank runs, but we also don't want to encourage reckless behavior.
Exactly. And this is where those checks and balances we talked about become even more important. Regulation needs to be strong enough to discourage excessive risk-taking while still allowing banks to perform their essential function of channeling funds to borrowers.
It sounds like understanding this complex interplay between banks, regulation, and our own behavior as depositors is crucial. So what does all of this mean for us? Why should we care about these Nobel Prize-winning theories?
This isn't just theoretical mumbo-jumbo. Understanding how banks work, the risks they face, and the safeguards in place is empowering.
Okay, I'm ready to feel empowered. Tell me how understanding all of this can actually make a difference in my life. Okay, I'm ready to feel empowered. Tell me how understanding all of this can actually make a difference in my life.
Well, for starters, it can make you a more informed banking customer.
Okay.
You'll have a better understanding of things like interest rates, fees, and the different types of accounts available, allowing you to make choices that align with your financial goals.
So it's like the difference between just grabbing the first apple you see at the store versus actually knowing which variety you like and how to spot a good one.
Exactly. And beyond personal finance, this knowledge helps you decipher those confusing financial headlines we see every day. When you understand the underlying mechanics of banking and the role of regulation, you can cut through the noise and make sense of economic news and policy debates.
It's like having a secret decoder ring for understanding the financial world. Instead of just feeling overwhelmed or confused, you can actually engage in those conversations and form your own opinions.
Precisely. And on a broader level, understanding these concepts helps us appreciate the delicate balance between stability and risk that underpins our entire financial system. It's a system full of trade-offs, and knowing the history, the potential pitfalls, and the safeguards in place allows us to be more informed citizens.
It's like we've been given a backstage pass to see how the whole financial system operates, from those everyday transactions to those big picture economic forces that shape our world.
Exactly. It's all interconnected. And by understanding these connections, we can approach the world with a more critical and discerning eye.
This deep dive has definitely given me a lot to think about. I feel like I've gone from being intimidated by the world of banking to actually being fascinated by it.
And that's the beauty of knowledge, isn't it? It has the power to transform our perspective and empower us to make more informed choices.
So, as we wrap up our exploration of banks, financial crises, and the brilliant minds who've illuminated this complex world, we're left with one final, thought-provoking question. If banks are essential but inherently flawed, what does the ideal financial system look like? Is there a way to design a system that supports economic growth and innovation while also safeguarding against those boom and bust cycles that have plagued us throughout history? That's something for you, our listeners, to ponder as you go about your day. This is The Deep Dive, signing off.